Hello, everyone. Felipe here. Hope everyone had an awesome week and is having a great Monday so far. So as you know, I'm here to keep you guys up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. So with that being said, I'll kind of give you guys a market update, see what I'm currently seeing in the markets, right? So, uh, interesting enough, corporate U.S. corporate debt defaults have surged. Corporate debt defaults are basically corporations that are not able to meet their liabilities, right? Pay whatever debt they owe, and they're defaulting on making those interest payments. And it makes sense, it's no longer cheap to borrow money because the Fed has made it more expensive to borrow money due to the increase in interest rates, right? Money has become more expensive to borrow. So debt defaults by U.S. companies surged 176% in the first 8 months of 2023 from the year earlier. Basically, high interest rates push more businesses into financial distress because it's more expensive for corporations to borrow money now and expand, as it is with low interest rates, right? When you can borrow cheap money for lower and pay lower interest rates on that borrowed money. It seems that the industries currently hit the most are media and entertainment. So basically, there's been a surge in U.S. interest rates, the highest surge since 1980, basically pushing corporations and businesses into financial distress due to being more difficult to borrow money or to meet the interest payments on that borrowed money. That's what lead to debt defaults, right? So the media and entertainment sector has been the most affected by the credit squeeze this year and saw January, August default surge sixfold from the year earlier period to 24. So more and more American companies are struggling to meet their debt obligations after the Federal Reserve boosted benchmark borrowing costs by more than 500 basis points, which is 5%. Over the past 6 quarters to tame inflation. So interesting thing I've noticed, it seems that, which is interesting to me, but inflation seems to have bounced back up a bit. And it's because I notice oil prices are somewhat going back up. Don't know where they're headed. I haven't put much thought or research into that. But yeah, I'll kind of show that on a chart a little later. So basically, U.S. firms are barreling towards a giant wall of corporate debt that's about to mature over the next few years. So this is an interesting scenario because what if a lot of these corporations cannot meet these debt obligations? And then they go into basically they default on their debt. That would be an interesting scenario, but it seems that a lot of these companies that have become accustomed to borrowing money for cheap because interest rates were low, basically from 2010 all the way up to basically early 2022. So they don't have the accessibility to borrow money at those cheap levels anymore. That puts more strain on the corporations to then have to pay more interest rate for that money they've borrowed, which can ultimately, if the corporation is not suitable financially, lead to them defaulting on those debt obligations. So the investment bank estimate that 790 billion of liabilities are set to mature in 2024, followed by 1.07 trillion in 2025. So those time frames would be an interesting thing to watch, because that means a lot of debt obligations are due around that time frame. And if a lot of these corporations cannot pay that interest rate they owe, we might potentially see massive debt defaults, right? Mounting debt-related stress in the corporate sector is also pushing more companies into bankruptcy. More U.S. companies collapsed during the 6 months. I'll skip this piece here. Silicon, so some of the companies have gone, have defaulted and basically gone bankrupt. Silicon Valley, Bed Bath and Beyond, which basically survived due to low interest rates and borrowing cheap money. Lordstorm Mortars. So Bed Bath and Beyond was basically a zombie company. And Media Math Holdings are some of the well-known names that went under this year. I've also noticed recently a couple of other big companies going bankrupt, such as Rite Aid, which I believe is like a pharmacy or something. So the surge in U.S. corporate failures likely embodies a greater economic risk than many in the market have accustomed for, and could be presaging an event that dwarfs the 2008-2009 financial crisis. And this is by Stephanie Pomboy. In a way, I agree with her. I sometimes you view data and all these things, and it kind of screams at you that something's not right. And it just begs to think a little more, that it seems very likely that things are not great, right? So the odds of pretty nasty recession seem to go up in probability. So basically, the global corporate default tally jumped to 107 as of August 31st, 2023, with 16 defaults in August, the highest August month tally since 2009. Media and entertainment defaults so far in 2023 are 6 times higher than at the point in 2022. Latin America is the pressure point, with emerging markets accounting for 13 of the 14 defaults year to date. So that's some stuff. On another note, this is what some like pretty knowledgeable investors are saying, Ray Dalio and others. So I always like to see what is their opinion on this kind of stuff. So basically, the concerns are growing U.S. debt will send interest rates up. Ray Dalio points out a supply and demand imbalance that will keep fueling costs, borrowing costs. U.S. debt supply will only grow as a recession would expand the federal deficit. That makes sense, because if a recession occurs and if it's pretty nasty, the Fed is probably going to step in and stimulate and low rates, as they typically do, fueling the already massive debt that the U.S. has. U.S. debt is ballooning. And that's I mean, you can just Google the U.S. debt clock and see how much the U.S. Debt has increased since the debt raise of the debt ceiling raise. The Treasury Department has already actioned $1 trillion in bonds just within this quarter. Meanwhile, borrowing costs have soared the last year and a half as the Federal Reserve embarked on an aggressive tightening campaign. Basically, they've risen rates quite a lot. So Ray Dalio says he won't invest in bonds and instead touted cash is good for now, which is interesting to me, because I mean, that probably means he thinks interest rates are going to keep going up, because bonds are paying pretty good interest rates currently. And if something occurs where the Fed drops rates, the value of the bonds appreciate. So it can present like a rare opportunity to make money off of appreciating bond prices due to falling interest rates. Dalia basically explained that a swelling fiscal deficit is forcing the Treasury Department to keep issuing bonds. But keep this in mind: interest rates are high. That means Treasury and the Fed are paying more interest on those bonds they're selling, right? Because bonds are basically IOUs. If investors aren't receiving high enough real interest rate, they will sell their bonds, he warned. I personally believe that bonds longer term are not good investments. Um, Longer term bonds are more sensitive to interest rate changes than short term bonds are. But that's, I kind of disagree with this in the sense that if a recession occurs that causes the Federal Reserve to stimulate the economy, that means interest rates will go down. And in interest rates going down, bond prices appreciate. And since long-term bonds are more sensitive to interest rate changes, that means they appreciate the most compared to short-term bonds. If you're playing the interest rate play where you're interested in getting the interest from the bond, short-term bonds make more sense. If your only interest is getting the interest rate or the coupon paid by the bonds. So interest rate gains would help drive demand for bonds. They make debt servicing mostly costly because interest rates are up. That means basically whoever is selling bonds, or whether corporations, the government, they're paying more interest to sell on those bonds they sold. When interest rates go up, the central bank then has to make a choice. Do they let them go up and have the consequence of that, or do they print money and buy those bonds? And that has inflationary consequences. I don't think the government is buying bonds now. That's usually what they do, and they're stimulating. But if they were, that is definitely inflationary because they're purchasing the bonds, right? Bill Gross, basically, he noted that a third of U.S. outstanding debt is set to mature in under a year. This is what is very interesting to me, the maturing of debt, because that is basically when we know who can pay for their debt and who cannot. And if a large sum are not paying their debts or the obligations, that is basically trouble ahead. To ensure that the Treasury can service this, it will need to attract a large swath of buyers. And then basically this relies on amping up interest rates. So basically Gross noted quantitative tightening, which is the increase of interest rates by the Federal Reserve, and tightening of money supply, right? Campaign worsens the supply-demand imbalance, given that it removes the central bank as a bond buyer. And a lack of demand means Treasury prices remain low, he warned. This could basically mean the actual value of the Treasury is low. It's lower because the value of the Treasury goes up when interest rates goes down. It goes down. It goes up when interest rates go down, and then it goes up, down when interest rates goes up. So basically, he's just saying that assets have to go up, or else the economy won't do well. Jeffrey Gundlach, the thing that will be so confounding to people is that once we get deeper into recession, bond yields will actually start to go up because of the excess money printing and monetary response. Maintains that a recession is likely within 6 to 8 months, as the pandemic era consumer savings are depleted, which I'll go into that shortly, and it's very interesting. So I basically, this is what he states. I think the Fed, in the back of their mind, realizes that when the next recession comes, the amount of borrowing is going to be so enormous that it's going to be a really bad idea to have interest rates higher than 5%. So that would mean interest rates will have to come down by a lot. So Interesting on another note, here, which let me see. Uh, this came up, which made me want to kind of like dig into this. So TD Bank in Canada had mortgages worth of 45.7 billion negatively amortizing in the third quarter per the Globe. So I might do some due diligence into that and actually look to see how that looks in their in TD Bank's finances, right? But that's a big bank in Canada, so I'm curious to see if they are in trouble, what kind of trouble they might be in, and a bank like them is most likely connected to other things. So if anything happens to them, potential, financial troubles, it's probably going to affect someone else, right? Or some other corporations. I found this interesting. So a year over year growth in investor purchases for real estate has dramatically dropped, negative 45% basically for the second quarter 2023. So you can see over here. So what this tells me potentially is that less sales are occurring in real estate markets, right? Less sales are occurring, less mortgage lenders are issuing out loans, less real estate agents are closing deals, right? So that's kind of what I'm getting from this statistic here, possibly. And that just means less income coming in or money coming in for the economy, right? So that's not a good thing to see, such a drop in purchases from investors in the second quarter 2023. Another interesting data that I came across is basically delinquency by type of debt. This is from 2006 to 2023. Delinquencies on auto loans, credit cards, and consumer loans are at their highest levels in decades. Experts say they could rise even higher. So the peach line is basically consumer loans, the yellow one is credit cards, and then the blue one is auto loans. But you can see here basically the delinquencies drop down dramatically from basically 2010 up to basically 2021. Cheap money, right? Low interest rates, borrow money for cheaper, less odds or less chances of delinquencies occurring, right? Interest rates go up, people take loans that have higher interest rates, it takes more money to service that loan, higher probability of it then leading towards delinquency, right? But this is basically now seemingly looks like a change in the trends where it was just consistently going down, and now as of like maybe late 2021, it started just going straight up, all three of these indicators. Another thing that is pretty crazy to me is personal savings compared to credit card debt change. This is pretty insane. Personal savings are basically near the lows, yet credit card debt has skyrocketed. And this is where I'm basically now kind of sitting back and speculating and wondering, if, like kind of I mentioned before, is this the end of a credit cycle? Because credit debt's out of control. The only way this gets fixed is flushing all the bad credit out of the system, right? Through bankruptcies, delinquencies, blah, 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 kind of like what occurred in 2008, right? It just all has to come tumbling down and get flushed out. And those are the really bad, nasty recessions, the end of credit cycle, end of credit cycles, because that means that's the end of the expansion, right? The expansion that typically occurs or has occurred from 2010, or for the most part, always since credit has been created, from 2010 to now, all of the expansion has mainly been through debt, right? Because people buy things they can't afford, or corporations, invest in ways that they just use a lot of borrowed money, right? Leverage. But this is pretty insane. When you compare to where personal savings are to where credit card debt is, that signals potentially trouble to me. On another note, just some charts here. This is USC SHP I, which is the Case-Shiller Home Price Index month over month. So basically, this thing is volatile as hell. But it from what I can see from this is basically from April 2023 until now, until recent time, real estate prices have dropped month over month. Here we can just add the YY and see the year. So it basically, here we're seeing that, since April, this is April 2022, as compared to April 2022 last year, prices are lower than they were then, right? The change has gone down from year over year. The major indexes, S&P, basically, just, I have no idea where this thing is going, but you got definitely some volatility here. But it is near or around where it was an all-time highs. But this thing is very volatile. It goes down 20% the other year, and then massive comeback this year, right? So down 24% for 2022, and then massive comeback this year, 2023, 26% up. And I feel it has a lot to do with the AI hype bubble that has been going on, because NVIDIA is just ballistic. Crazy. I mean, if you tell me this is not a bubble, holy crap. This is ridiculous. Rocket ship straight up to the moon kind of returns. It seems that it has been going down lately, but I have no idea where this is going. It's just pretty interesting what the AI hype caused in some of these semiconductor companies, which I feel is what has basically kept the market up. Because in reality, the only companies that have done well this year, stock price wise, are tech companies. Pretty much, as you can see from NVIDIA's ballistic year this year, right? It's just a rocket ship. So with that being said, I'll leave you guys with a good market quote. A highly favorable purchase is very likely to seem odd, uncomfortable, risky, dull, or obscure at the time you buy it. Perpetuous reactions are the dog, or I can't see it doing anything for the next 6 months. Later, everybody gets the idea and feels comfortable or enthusiastic about it. Then it's too late. This basically just goes that traditionally, buying the unfavorable, unpopular, however, financially strong company is typically the contrarian thing to do. But they say contrarians are usually the ones that do well in the market. So if you like what I shared with you guys today, and would like to hear more, please like and subscribe. I would really appreciate that. And thank you guys for your time. Have an awesome week.